how do you decide whether it is going to be a 2% allocation or is it going to be, upwards of 7 to 8%?
The number of stocks goes to around 15, 16 or somewhere around 20. Most of the benefits of diversification are already in the portfolio.
What are some of the non-negotiable qualitative factors that you look at?
Person who will steal for you is a person who will steal from you. You would rather be creating HNIs rather than chasing HNIs.
So, looking back over your career, any one experience which influenced your evolution as an investor?
Take advantage of opportunities that come your way in times of distress. Just be mindful of the taxes and avail of all the tax shelters that are available to the end investor.
In an industry obsessed with what's working right now, Reality Check exists to ask a different question. What actually stays true across every cycle? Today's guest has spent over 3 decades in the market through booms, busts, and everything in between, and has built a reputation less on predictions and more on timeless principles that haven't changed along with the calendar. He's responsible for spearheading one of India's most respected and organically grown fund houses in the country and is someone who lives by a value investing principle very few in the industry can mimic. He's someone who's lived by it cycle after cycle. He's known for being direct and completely allergic to noise, and exactly that's why we wanted him to speak to us today. Joining us today is Mr. Rajeev Thakkar, Chief Investment Officer and Director at PPFAS Mutual Fund. Sir, thank you so much for joining us today and for your time.
Thank you for the opportunity, Megha. Wonderful being here.
So let me begin by asking you on timeless principles of investing. I'm sure in 30 years you have seen a lot change from regulatory evolvement to how technology has changed the research process, how investors have changed and evolved over a period of time. I'd like to understand from you what are some of the timeless principles that haven't changed, and what are some of the principles that have evolved for you in your experience with learnings from the past?
So what has not changed is the first principles which are there. So people who join the commerce stream after grade 10 have this subject called organization of commerce. Within that, they learn that there's a form of business called the joint stock company. And if you own shares in that company, you are part owner of that business. So that hasn't changed. Looking at uh, buying one share of a company, the same principles that you would apply if you were to buy out the entire company, those same principles go into that buying that one share. Uh, what is important is importance of the people running the company on your behalf, which is the board of directors, plus the managers who run the company day to day. Both these groups should be competent, should be trustworthy, and should be hardworking for you to earn in your investing journey. And the other principle that is timeless is the importance of buying at the right valuation, not overpaying for your purchase, irrespective of how good the business is.
And so, what are some of the principles that have evolved with changing market conditions?
The principles as such don't evolve. What changes is the nature of some of the businesses. So, for example, humans have this desire to be entertained. Now, what used to be street plays or theaters moved to the motion pictures and cinema houses, and that has moved now to OTT as a means of entertainment. So the nature of the business changes. Earlier, people would get their news from town criers to newspapers to television news to now the internet. So the medium of delivery or how the businesses operate, that changes, but principles are more or less timeless in that sense.
So, if we look back, say about 15 or 20 years ago, a lot of fund houses, marketed based on the star fund managers. But, in the last 10 years or so, we have seen that, the narrative has moved from the fund managers to the processes. But herein lies a situation of a double whammy of sorts, if I can call it, because, we understand that processes guide people, but it is the same people who design these processes and are responsible to execute them as well. So there is a very delicate balance that, possibly exists. My question to you is that how do you think about this balance being maintained at Parag Parikh? And I'm sure you've been asked these questions on multiple occasions, so as to ensure that, processes stay sanguine and are not dependent on any one individual.
So, as any investor would like, is that the organization is bigger than the individual, because otherwise, so humans have the fragility of falling ill or passing away and or resigning from an organization. All the causes of attrition can be there. When people are entrusting their investments to an organization, they would want a certain level of continuity and a certain uh, level of processes to be there to be safe while entrusting their money. At the same time, as you pointed out, end of the day, organizations are run by people. So the people have to have that culture and willingness to imbibe the principles laid down and follow them on a day-to-day basis. So our beginnings were as a small organization where the number of individuals with the company were fewer. So this would be less than 100 people. Today we are north of 300 people. So what we have done is over a period of time, we uh, have this uh, allocation of responsibilities, work according to each person's capabilities, so that we are able to leverage the best talent to the fullest extent possible, and at the same time have these redundancies in place. So if someone is absent for some reason, then the work goes on, and there's always a backup available for the key roles that are there. And while I would not call it star managers or anything like that, but people who have been around longer or people who represent the organization in public media or who are the client facing, distributor facing people, we carry this extra responsibility of narrating the stories around the organization, around its history, and ensuring that the relatively newer people know the background of the company and uh, have the same culture uh, systems that have been around for long. So that way we arrive at a mix of both processes as well as the best of people that are there.
So coming to research, now there is a lot of narrative about different kinds of research, be it through artificial intelligence, be it through alternative data, etc. I'd like to understand from you, before you even start valuing a company, other than the quantitative factors, which could be the valuation, ROC, return on equity, etc. What are some of the non-negotiable qualitative factors that you look at, and how do you analyze different modes in a business?
I think one of the key non-negotiable for us is the promoter and management quality. So there is this one line from the author Thomas Phelps. He wrote in the book many decades ago, 100 is to 1. So he had this line in the book saying that the person who will steal for you is a person who will steal from you. Uh, so a lot of people ignore governance. If someone has, let's say, evaded taxes, then the approach is, so why do I care? Meaning they've probably saved taxes for the company that we have invested in. or they've evaded customs duty or corporate tax or whatever. But if the ethics are not correct, then they would probably go out and cheat the minority shareholders as well somewhere down the road. Uh, and unlike the Western markets, uh, where the class action lawsuits are very common, or where activist shareholders are common, where if a CEO is not performing the role properly, the CEO gets thrown out by the shareholders. In India, largely you have a dominant shareholding group. Now, this dominant shareholding group could be Government of India, could be a business family in India, or could be a MNC holding company which is based abroad. But as minority shareholders, we can't do much to influence the board composition or the CEO selection. Hence, the only chance that you have is while buying the share. After you have bought into the company, you cannot do much, and hence it becomes a non-negotiable in terms of the research process. Otherwise, the research process is a standard process where you evaluate the uh, quality of business, you evaluate the uh, promoter manager group, and you buy at the right valuations. In terms of the business quality, largely it would be around the extent of competition and the where does the power lie in the value chain. So you could use the Porter's framework in terms of the bargaining power of suppliers, bargaining power of customers, and the number of competitors in that space, how easy it is for others to enter this space and compete away the margins. So those kind of things can be looked at. One looks at the capital intensity of the business. The usually the lesser the better. You would look at quantitative metrics like return on capital or return on equity. Again, barring utilities and barring the banking and financial services space, one would typically not want too much of leverage on the balance sheet. And after all these things are considered, one would want to buy at a reasonable valuation.
My next question to you is, we often spend a lot of time analyzing, the stock selection in general for the different funds, that we hold, or, that becomes a part of, the watch list, etc. But in your fund, we have always seen a lot of conviction around position sizing, and you have largely ran concentrated portfolios, even in a flexi cap space, which is really not easy, especially at the size of the fund that you are currently managing. I'd like to understand, how do you decide whether it is going to be a 2% allocation, or is it going to be, upwards of 7 to 8%? What are some of the key considerations that go into this, and how do you probably start building up to reach that 7 to 8% at the given size of the portfolio?
So before we get into this question, let me take as a thought experiment two very extreme positions, and which will make the thinking clear around this. So as an extreme, let us consider having a single stock portfolio where 100% of the corpus is invested in a single company. Now, if this company's share price were to fall by half, your portfolio NAV, your portfolio market valuation would fall by half. So this is a very extreme kind of situation, a very concentrated portfolio. At the other end, let's look at a 1% allocation to 100 companies where you have 100 positions, and each position is 1% of the portfolio. Now, in such a portfolio, if some stock that you like, that stock triples in value, 100, if the stock price is quoted at 1, the stock price starts quoting at 3 in a short span of time. But at the portfolio level, your portfolio return will only be 2%, because even though the individual stock tripled, but the weightage was very less, and hence did not move the return needle meaningfully. So these are two extreme situations. We don't want too much concentration because it becomes very risky. We don't want excessive dilution because then your best ideas get diluted in excessive diversification. So a lot of work has been done on this by academicians as well as practitioners, and it is seen that once the number of stocks goes to around 15, 16, or somewhere around 20, most of the benefits of diversification are already in the portfolio. And then the risk really does not come down so much as you add more and more companies to the portfolio. So given that we work in a mutual fund context and where we would further want to lower the overall ups and downs in the portfolio, we typically look at a 25, 30 stock kind of portfolio, where typically the average weighting would be around 4% or 3% or thereabouts. Uh, Sometimes what happens is if the business is reasonably large, if the business has diversified income streams and it is not linked to just one particular geography or just one particular niche line of businesses. In such situations, one can afford to have a bigger weightage to such a position because you know that the riskiness is uh, not too much. Let me make this more clear by giving an example. Let us say we are evaluating two different businesses in the lending space. Uh, Company A could be a diversified lender which operates pan India and which has multiple lending businesses and multiple sources of funding. This would be typically something like a bank. Whereas company B is also in the lending space, but is in a niche geography. Let us say it is either south based or east based. It's operating in maybe a single line of business or two lines of business. Maybe it's a gold lender or maybe it's a commercial vehicle financier. In which case, obviously, the second company has more risk based on the business model as compared to the first company, which is more diversified in that sense. So, where the business is more diversified, larger, and in various geographies, etc., has been around for a long time, you are more comfortable having slightly higher weightage as compared to a small niche business.
What I understand from you is it is the size of the business opportunity that probably governs this decision for you.
Opportunity, yes, but also diversity. So, let us say a tech business, a software company which has uh, 40% or 50% revenue coming from one client is obviously more risky than someone who is having 15 different sectoral exposures and the top client exposure is not more than 8 to 10%. So it really depends on how risky that individual business is. Opportunity is a different matter. Sometimes you may, even in a niche business, you may feel opportunity set is huge, but one would not risk beyond a point in terms of giving weightage to such a company.
So, one observation that I've had after listening to you for so many years has been that, you have always maintained the fact that, a wonderful business doesn't automatically mean a great business. You have cited examples, from the aviation sector, you have cited examples from the telecom sector in this regard. And you've also gone on to say that, the growth of the economy has nothing to do with, what you are going to make, as returns in the market. So I'd like to understand what is your framework for separating quality of business from attractiveness of the investment opportunity?
Yeah, so I'll split the question into two parts. One is a lot of people are fans of thematic investing or sectoral investing. They feel that oh, now the government policies or macro trends are such that this sector or this theme is going to do exceedingly well. So let me overweight in this particular theme or this particular sector. So that is the context where I give the examples of the telecom and the aviation industry. So mid to late 90s was when these sectors were opened up. Earlier, they were government monopolies. So Indian Airlines was the only airline for domestic civil aviation, and this was opened up to private airlines. And not a single airline of that era is around today. All of them went bankrupt without exception. Telecom sector was opened up. Only one company of that era has created wealth, which is Bharti Airtel. The other company which is still around in some form but has not made shareholder returns is Vodafone Idea, and all the other companies of that era went bankrupt. So over there, what I have to say is that the opening up of a sector or volume growth that you see in a particular sector need not translate into shareholder profits. And the reason why that happens is if competitive intensity is too high, uh, where all the value created goes to the end customer instead of the shareholders, then you have this kind of a situation. The other example where a great company need not be a great investment, the examples are from IT services companies in the late 90s. Here, companies like Infosys and Wipro were great businesses end of 90s and were great businesses in, let's say, 2006 or 7. But the valuations were so high in 99 and early 2000 that for next 7 years, investors were either underwater or barely broke even after 7 years. So there are two kinds of things. One is where overall there's a hype in a sector, but the sector itself does not make too much profit. So that is one example of this theme. And the other example is where the uh, companies are inherently profitable, but the valuations become so out of sync with fundamentals that even after long periods of time, let's say 7 years or 10 years, the investors end up not making too much return.
So now, coming to industry evolution, and the reason why we're asking this question is that you have been a kind of trendsetter in this space, and let me come to that. So you started as a PMS house, and then you moved to mutual fund in 2013, and now we are seeing a lot of successful PMS managers following the same path. Now, we do understand that there is a merit for an investor to look at mutual fund. There is a lower ticket size, there is a tax efficiency, you can diversify your money much better. But from an asset manager's perspective, what makes mutual fund so compelling? I mean, is it simply that the scale of flows into mutual fund is very high and that's the reason everyone wants to have a mutual fund? Or is there a deeper strategic advantage for this evolution?
So, different people will have different objectives. I think anyone who wants to service a large number of customers, uh, relatively higher AUM, and at the same time is willing to work on lower margins, would find the mutual fund space more attractive. People who don't want the hassle of uh, the higher level of compliances that come with the AMC setup, or people who want higher margins in terms of higher fixed fees and some kind of a performance fee kind of coming to them. Those people would be attracted to a PMS structure or a AIF kind of structure. In our case, when we were the operating in the PMS category, at that time the minimum ticket size was rupees 5 lakhs for a person to avail of PMS services. And at that time itself, discussion was in terms of increasing the entry ticket to 25 lakhs and beyond. That happened first 25 lakhs and now 50 lakhs. So we felt that we would want to service a large number of customers, uh, enable people to participate in the growth of Indian equities. So our founder used to say this frequently that we would rather be creating HNIs rather than chasing HNIs. So that's where we chose the mutual fund structure for servicing our customers.
So now, from mutual fund evolution to fund manager selection, and some part of it has already been discussed by Mega in the previous question. Now, when we look at most of the investors, especially DIY investors, how do they invest? They look at the recent returns or they look at the star rating. And we do acknowledge that this is not the way how one should go about fund selection. But if I have to ignore these, and if an investor who is looking at this podcast want to learn about it, so what should an investor choose from a fund house or a fund manager? So, what are the key variables one should look at? And once they have made that choice, how should they react if the fund manager leaves or if the fund house is acquired by someone else?
So ideally, when people are investing in equities, it doesn't matter so much in, let's say, something like a liquid fund or arbitrage fund. But when people are choosing actively managed equity schemes, then they are looking for a particular investment philosophy, particular continuity of the organization as well as the individuals. Uh, we unfortunately we have had situations where some of the uh, foreign players who speak about decadal investing in equities came and went away in a relatively short span of time. So organizations themselves were here only for 3 to 5 years. And again, sometimes the manager churn is also pretty high in certain schemes or certain fund houses. We have had counter examples as well. So we have had managers who are managing the same scheme over a decade or sometimes 1.5 decades, 2 decades. So those are the examples where people feel comfortable. For good or bad, the same individual is going to be around to answer the questions, to explain the investing rationale, etc. Otherwise, individual A has come and explained why uh, some stocks make sense, and after 2 years, some different manager is there who cleans out the entire portfolio and does something else. That creates some disturbance. We have had good examples also in terms of situations where organizations have had a particular investment culture and where even after an individual left, the next person coming in was part of the same team and who stepped into the shoes so that although the phase changed, the processes and the philosophy continued, and there was some element of continuity in the investment team and investment process. So that really builds confidence among the investors. So you have a few large listed AMCs now. In that, you have had some investment professionals who have been around for 10 years, 15 years, 20 years. In many cases, you have had promotions happening from within the team. So someone who joined as an analyst in the fund house, let's say uh, 7, 8 years back, got promoted to a fund manager role and took over some of the schemes. So in those cases, uh, a change in the fund manager name doesn't matter so much because anyway the new fund manager was part of the same research team. So there is an element of continuity. So there is some level of nuance here, but people can figure out which are the more stable organizations and funds and which are the organizations and funds where there's too much churn at the organization as well as the manager level.
I think now a lot of AMCs have stock option pools and all those things also to retain fund managers. So I think that would also help over a longer period of time. So now, coming to the decision framework of the investor. So till now we have discussed the decision framework at fund manager or a CIO level. Now let's look at the investor. Today, investors have so many choices than what they had 10, 15 years back, whether to choose between active or passive mutual fund, whether to go for a mutual fund, PMS or AIF, whether to look at Indian equities or global equities. Now, we do understand that more choice is generally a good thing, but it can also make investing very confusing. So, if you had to share just 3 or 4 guiding principles with our investors, which would help them declutter these choices and simplify their journey without compromising the long term quality and the return, what would those be?
One very simple criteria and one which is timeless is be mindful of the taxes and avail of all the tax shelters that are available to the end investor. So, under the Income Tax Act, up to 7.5 lakh rupees contributed by the employer to retirement funds, be it NPS or be it EPFO, that doesn't add to your taxable income. So that should be used to the extent possible by the end investor. In fact, recently there has been an amendment to the EPFO Act where only 1800 per month is mandatory for EPFO. Remaining can be put in NPS. So that is something that people should actively use. Uh, an upfront tax break uh, for your retirement is definitely something you should avail of. The second principle that people should keep in mind is if your investment horizon is up to 12 months, stick to liquid funds, arbitrage funds, money market funds, or bank FDs. Don't put that money in equities. If your horizon is around 3 years, hybrid funds are the way to go and choose equity only for the longer run. That's another principle which should be kept in mind. Generally speaking, try and avoid sectoral funds and thematic funds. Stick to diversified equity funds. Within diversification, while sectoral and market cap diversification is important, so is global diversification. India is only about 4% of global market cap. 96% of global market cap is outside of Indian companies. So at least have some portion of your equity savings invested in non-Indian equity indices or shares. As long as someone keeps these things into account, the general outcome should be good. Obsessing too much over active versus passive or selection of fund A versus fund B or obsessing endlessly over whether right now one should go in for a small cap fund or a mid cap fund or large cap fund, that doesn't matter as much as the underlying choice of an asset class. How much did you put in equity versus how much did you put in fixed income and for what time horizons?
So I never expected that you would give an answer which would cover EPF and NPS as well. And that's the reason we respect you a lot, because you gave a holistic framework on how asset allocation should be at investor level, and just not talked about equity, which many people around keep talking. So with this, we come to the end of our conversation, and one last question to understand from you. And this is really important because, be it as investors or be it as, you know, senior fund manager or CIO, every one of us would have had those experiences which leave a few scars with us. And I'm not referring to, picking up a bad stock or, having a bad allocation in some stock. But what I'm talking about is, in your career, you would have had at times maybe a flawed assumption or incorrect framework or mistake in the investment process that changed the way you looked at investing. So, looking back over your career, any one experience which influenced your evolution as an investor, and what should, as viewers or as investors, we should learn from that?
So this is more on the side of personal finance. This is both my lived experience at some point in time and observation from some other people at a different point in time. So what happens is uh, the tough periods don't come from just one side, they come from multiple angles. So, like they say, when it rains, it pours, or there's not just one thing that can go wrong. Sometimes multiple things go wrong at the same time. So, first such thing happened in 2008 and 2009, around the time of the global financial crisis. So that was a very opportune time for investing in equities. At the same time, there were some expenses that came our way. So uh, the entire cash savings that were there got diverted to the expenses that came up, and one could not take advantage of the opportunity that was there in terms of the low stock prices that were there in 2008 and 9. And in the time of COVID period, also one saw this with a certain set of investors. These investors were temperamentally very strong. They were not perturbed by the fall in stock prices that happened in the COVID period. But unfortunately, what happened for them was that job losses came at the same time. So at the time of lockdowns, a lot of people were unable to keep the employees on rolls and had some forced attritions. So people who lost their jobs had to dip into their savings to meet the regular household expenses. And hence they were forced to sell some of their investments at precisely the wrong time. So across these two time frames, the importance is of keeping a reasonably adequate emergency corpus, which is there in short term, either liquid funds, arbitrage funds, or bank fixed deposits, so which can allow you to stay the course uh, in equities and at the same time take advantage of opportunities that come your way in times of distress.
Yes, we totally resonate with you. And, this last answer and the answer before that was actually something which, as advisors, we should be talking more to the investors. And so, with this, we come to the end of our conversation. And what a delight of a conversation it was, because not just learning about your framework, but it gave a good outlook on how the industry operates and how the investing framework in broader sense should be looked upon as. So a few learnings which I have jotted down for the benefit of the viewers. So first one, which you started with, is that buying one share should be looked upon as buying the entire company. So the framework to decide buying even a single share should be in the same league as if you're deciding to buy an entire company. Second, you mentioned very important point is that the nature of the business changes, like you mentioned about entertainment changing from Nooker show to OTT, but the principles don't change much. Then you elaborated about how mix of people and processes play a significant role, because most of the people we talk to at times they just say processes, 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 but you also alluded to the importance of people. Uh, when you mentioned about how diversification play out, that when the number of stocks go beyond maybe 20, 25, or even 15 to 20 that you mentioned, the incremental addition of a stock does not add to incremental diversification. Then interesting point, which was really enlightening, was that on how you take higher weightages in those stocks where the income streams are diversified. Uh, One interesting point which you have discussed earlier as well, when you gave example of airlines and telecom, is that when the competitive intensity is on the higher side, the end consumers take the entire advantage and not the shareholders. Then how you believe in creating HNIs and not chasing HNIs, because most of us, I think, end up chasing HNIs, and that is something which we should also introspect about. Um, Change in fund manager is very contextualized. Like if somebody is being promoted from within the company, then it should not be a cause of worry. But if the fundamental guiding principles are changing, then it's a cause of worry. Then you mentioned very important point on personal finance, on how one should be mindful of taxes and tax shelter. Here we are not discussing tax avoidance, but we're looking at optimizing the taxes. Try to minimize themes in the portfolio, be flexi investor or be diversified investor. And how global investing is also very, very important. And to your credit, you are one of the few funds or fund houses which took allocation in their FlexiCare fund for global allocation. Then you said that, when these are tough times, and these are guiding principle, not just for this podcast, but in life as well, that when it rain, it pours. So, it's something which we always see around us, but we forget. And so, lastly, one important punch which I'll carry with me, which you refer to in this session, which is very, very profound, is that a person who will steal for you will eventually steal from you. And I think this is something which I'll carry home with me, because A, we are fiduciaries, we are responsible for others' money. B, we run our own enterprise also. And I think that's where this becomes extremely important. With this, we end our conversation. Thank you so much for taking out time from a busy schedule and patiently answering all our questions. I can't thank you enough, sir.
Thank you for the option. Thanks.